Dinshaw Irani of Helios Capital Management joins in now. Dinshaw, it would be unfair if I don't ask you what you're making of the Nifty crossing about 25,000 once again, and it seems like a new record could be on the cards today itself.
Morning, Samina, and thank you for having me on your show. And a very good morning to you and your team and viewers. Okay, so here's how it is. So basically, the Asia actually was doing fairly well till not so long back. I mean, the India didn't participate in the recent rally that Asia had undertaken. So I think it's a catch-up which is happening for us from here on. But having said that, our feel is that given the kind of fundamentals, or rather the last September, sorry, the June quarter results, and even looking at the March quarter results, the fundamentals are somehow not supporting the kind of rally that we're seeing today. So maybe you'll see us, somewhere flatlining at this line, this point, and probably doing a time correction going forward.
Oh, well, that's good to hear. You're right. Those earnings are behind us. None of it has kept up with the kind of gains that the equity markets have seen. And a time correction healthy in every way and form. But clearly, every dip in this market seems to be getting bought into. That's the view coming in on the markets. But we'll quickly do a detour then, show and continue talking about our markets and where you see things go from here on. Then, to begin with, and I want to build on that frothy valuation conversation with you. It's been spectacular, the kind of rally that the markets have seen, not just in the last 1 year, but over the last couple of years, where barring 2022, the Nifty has done double-digit returns over the last 5 years. We're at a juncture where the market is full of new investors and investors who still don't get the nitty-gritties of disciplined investing. Case in point, valuations have spiked across sectors, across market cap, including sectors which are probably on opposite ends of the spectrum. So, for example, EVs are doing really well, and so is traditional autos. Quick commerce is doing well, and so is traditional retail. Now, none of these two can continue to be gainers, right? One will have to take the back seat. How concerned are you about these valuations? And is it a near-term concern or more of a longish kind of worry that you have?
So, India got re-rated, okay? There's no doubt about that. The fact that the market was going so well and the GDP was going such a healthy space. So it was obvious that India needed to get re-rated, and it did get re-rated. To manage that, I mean, and re-rated is pretty good re-rating. In fact, if you look at the last 20-year averages, we're at some 17, 18 times, or even if you look at the last 10 years, we're at 90-time forward earnings, which now today is around 23, 24 times. So that's like pretty healthy for a market to get re-rated. And you've seen the kind of weight that India now commands in MSCI. In, I think, September of 20, the weight was around 12%. Today, it's close to 20. So it's obvious that we massively got re-rated. And obviously, the flows also are to that extent the way they were. I mean, from the FIs were helping that out also. But to manage that re-rating, Samina, from here on, you need to show that kind of growth impetus, right? And the re-rating was on the back of that. Yeah. Now, if you look at the last 4 quarters, the growth, if anything, I mean, I'm talking about the earnings growth for the index, if anything has come off. In fact, the last reported quarter, which was June, the earnings growth was in like low single digits. And if you take away the banks from that, it was a negative 7-8%. That's not healthy. And that's why the valuations from here on, to manage even this re-rated valuations, you need to show growth, which I don't think is going to happen. Even the September quarter doesn't look that healthy. I mean, if you talk to corporates and manufacturers, they're not giving out a very healthy sign. And then that's on the back of the fact that consumption is not picking up. So maybe that is, you may see the valuation stretch. However, having said that, if you look at the various components within the market itself, I mean, there are pockets of comfort and there are pockets of froth, right? And even within that, if you look at the market cap wise breakup, probably the large caps are the cheapest of the lot today. The mid caps are at massive premiums to large cap, which, I mean, I was once reading a report on how the valuations have worked out in the last 10 years. The average premium that the mid caps normally command is around 20%. It's gone to 70% plus. Definitely not possible to hold on to those levels. If you look at the small caps, normally they quoted a 10% discount to large caps, and they today at a premium of 5-6% to the large caps. So it's obvious that maybe if you want to hide, maybe large caps is the place you want to be in.
Just taking that conversation ahead, we've very clearly borrowed returns from the future from the way we look at the index at this stage. Would it then be very immature to continue expecting the markets to deliver even late single digit or double digit returns over the next 2 to 3 years?
So no, so I mean I won't agree with that. I think basically the point is that, as I said, growth rates have to kick in, right? So maybe you'll see those kind of growth rates coming back into form by probably March of the next year as such, because that's the quarter when the festive season kicks up. And actually December is the quarter, but December was a high base for us. So maybe March is the base where things started, going down a bit for in terms of profit growth. So you'll see that base also playing up to that extent. And maybe that's why we say the base case for the current year up to probably say December or middle of next quarter as in I'm talking the March quarter. Things may be a flat line, but mind you, I mean, in these flat lines also there are pockets which grow by 10-20%. There are pockets which do go down by 10-20, and that's where you want to be, in the pockets which are growing as such. So hopefully we'll be able to find that out.
Hopefully then, sure. But if an investor is watching us, and I know the right way to do this is to stagger your investments, do it over a longer period of time. It's not about timing the markets, it's about time in the markets. I mean, we've all heard of all this, right? But sometimes getting the timing right, and if you bought the markets at the peak of the pandemic, you'd be laughing your way to the bank. Where do you think incremental money should go? Should it stay in cash? Or do you advise investors to probably double down on large cap space, because that's where there is some valuation comfort? But the fact also remains, we've been harping about large caps catching up since mid or late last year.
So actually, Samina, I don't think it's a large cap, mid cap, or small cap space that one should be looking at. One should be more focused towards the sectors that are looking much more healthier as such. I mean, look at financials, right? They have not done much in the last. In fact, in this whole rally, I suppose they've not done much. And frankly, I mean, it's only pockets of finance, basically banks, and that too private sector, which have not participated to a great extent in this rally. So maybe. That is one sector you want to look at, not the banks part, but the services part of the financial services sector. So I think that is much more exciting. And in fact, that's what we very kicked about. In fact, look at all the market participants, which I'm talking about non-lending space within financial sector, right? So that's where I think the real euphoria lies today. I mean, if you look at our portfolio, you'll see a lot of these names cropping up in our portfolio. Secondly, I think IT, which is one sector which we've been fairly away from for a while, but given the situation in the market today, I think that's a lovely sector to own, because given the fact that people want to hide money. I mean, not hide, sorry. People want to go for safe sectors. Now, one safe sector which has been considered is obviously FMCG. But look at the valuations of those stocks, 60, 70 times forward earnings from growth rates of 11, 12%.